Hi, I'm Glenn Frank, Director of Investment Tax Strategy at Lexington Wealth Management. I've also been a professor for many years at Bentley University. I teach portfolio construction courses. Knowledge is power. Today we're going to work on your strength. Let's start with the investment process. Financial needs. What returns do you actually need to get through life? Retirement, college, gifting, etc., etc. Secondly, that determines your asset allocation, which is simply what mix of asset classes are best suited to get you those returns that you need. Third, asset capture. Once you decide which asset classes to invest in, how are you going to actually do it? We'll use mutual funds, separately managed accounts, ETFs, whatever. Fourth step, investment location. Once you've decided on the investment asset class capture, where will you actually hold those investments? If it's a mutual fund, will you hold it in a retirement account, taxable account, Roth, trust, what have you? Fifth, asset rebalancing. This is all very circular. So things will change. You will change. Maybe you won't be able to sleep at night. Maybe your portfolio needs to be rebalanced. And it takes a lot of discipline to buy low, sell high, easing up on the investments that have done well, buying more of what's done poorly. Ideally, the ride provided by the investment process is smooth, so smooth that you can fall asleep in the back seat. But remember, if you don't keep the process disciplined, the car is likely to veer off the road. I love this quote from King Solomon. Send your grain across the seas, and in time, profits will flow back to you. But divide your investments among many places. For you do not know what risks may lie ahead. When clouds are heavy, the rains come down. Farmers who wait for perfect weather never plant. If they watch every cloud, they never harvest. Plant your seed in the morning and keep busy all afternoon. For you don't know if profit will come from one activity or another, or maybe both. Let's fast forward a few thousand years. It's the mid-'80s. David Swensen takes over the Yale Endowment. He's got this dilemma. How do I get higher returns without higher risk? So based on modern portfolio theory as popularized by Harry Markowitz, he decided to put together asset classes that really might be risky by themselves, but they behave differently from each other. They have low correlations to each other. Basically, they got zigs and they got zags. You put them together, and even though they're individually risky, together the portfolio has lower risk. A simple example of this concept is, say you have a company that sells suntan lotion in your portfolio. If you go out and buy another company that sells swimwear, they're both going to go up and down with whether it's sunny out. A much better diversifier is to buy a company that sells umbrellas. And basically, rain or shine, you should make money, and you've taken lower risk, and basically you've gotten free lunch. So why diversify? If you take a look at this chart here, we're comparing the smooth ride versus the rocky road. The smooth ride has a pattern of returns that is smooth. Ranges from 0 to 10, year in, year out, with an average of 5. The rocky road, on the other hand, is much more volatile. The swing goes from anywhere from -10 to +20. And as a result, there's a significant reduction in accumulation. So the moral of the story is get higher returns with a smoother ride, because lost years are compounding killers. A more rational way to invest is at the asset class level. This colorful chart shows 12 different asset classes represented by 12 different colors. And they're ranked in order of performance. Top performers at the top, worst performers at the bottom. And it's over the last 15 years. What's interesting is when you go to white. White is the average of each of the 12. So predictably, it's kind of in the middle. But is it guaranteed mediocrity? No, I think it's guaranteed superiority. Look at the right-hand side. So this was a sleep at night portfolio, yet it had one of the best results. Why? Low correlations, better compounding, they've minimized the lost years. That's the magic. Another great takeaway from this chart is how truly unpredictable the colors are. Other than black, which is predictably miserable in terms of accumulation, white is really the superior risk-adjusted return, which is by far the most predictable. The last takeaway is not so obvious, yet perhaps it's the most critical, and that's the emotional aspect of investing. The cumulative returns assume that the investor was actually able to hang in there for 15 years in that particular market. Would you have been able to? So if you want a free meal, stay invested, stay diversified, and above all else, remember, be patient.